As of the market close on Friday, April 24th, 2026 at 4 p.m. EDT, Supermicro Computer Inc., trading under the ticker SMCI, finished the session at $29.08. This represented a substantial upward move of 8.71% for the day, with the stock gaining $2.33 from its previous close. Even in the after-hour session, the stock showed continuous activity, hovering around the $29.13 mark. While a nearly 9% jump in a single day might suggest a return to the glory days of the AI boom, the reality under the hood is far more complex and involves a massive tug-of-war between high-speed revenue growth and a staggering collapse in profit margins. Most investors see the $40 billion revenue guidance for the 2026 fiscal year and think the stock is an obvious bargain at these levels, but they are missing the fact that Supermicro is currently sacrificing almost all of its pricing power just to keep its assembly lines moving. The expectation in the market right now is that Supermicro will simply ride the coattails of the Nvidia Blackwell cycle back to its former highs. People see the partnership with major chip makers and assume that more volume equals more value. However, the reality is that Supermicro's gross margins have recently cratered to approximately 6.3%, a far cry from the double-digit margins investors were used to seeing just a year ago. This margin compression tells a story of a company that is being squeezed by its own customers. When you are dealing with hyperscale data center providers, they have the leverage to demand razor-sharp pricing, and Supermicro has been forced to accept these lower-margin deals to maintain its market share. This creates a curiosity loop for the savvy investor. If the company is projected to hit $40 billion in revenue but can't keep its margins from sliding, is it actually becoming a more valuable business, or is it just a high-volume pass-through for expensive hardware? We see a lot of activity on the Robinhood app and various investing sites where retail traders are trying to catch the falling knife, but institutional activity shows a more cautious stance. Big funds are looking at the recent Department of Justice developments involving export control allegations and wondering if the governance discount is finally priced in or if there are more shoes to drop. The stock is currently trading at a forward price-to-sales ratio of about 0.30, which is significantly lower than the industry average. To a casual observer using a basic online investment tool, this looks like an absurdly cheap valuation. But for those doing deeper self-investing, the question is whether that low multiple is a gift or a warning sign about the sustainability of their business model in a more competitive AI server landscape, where Dell and HPE are aggressively fighting for the same ground. Recent trading volumes have been elevated as the market prepares for the next earnings report on May 5, 2026. This upcoming report is the ultimate reality check. The market expects a beat on the top line, but the real focus will be on whether the gross margin has finally found a floor. If management can show that their new data center building block solutions, or DCBBS, are actually contributing to higher profits, the narrative could shift back to growth. Right now, these higher margin solutions only account for a small fraction of the total profit, but the company claims they will reach double digits by the end of the year. This is the tension point. The company is expanding its footprint in San Jose and scaling up to 6,000 racks per month, but all that capacity requires massive upfront capital. This has led to negative operating cash flow in recent quarters, which is something you rarely see in a company that is supposedly in the middle of a historic boom. When you look at Supermicro stock compared to the broader tech sector, it has been a total outlier. While Nvidia stock and Apple stock have largely navigated the macroeconomic pressures of 2026 with resilience, SMCI has been a roller coaster of volatility. This is partly because Supermicro operates as a system integrator. They don't make the chips, they buy them from suppliers and build the racks. This means they are at the mercy of their supply chain. If there is a shift in demand or if a competitor gets better allocation of the latest GPUs, Supermicro's speed to market advantage evaporates. Many people using interactive brokers trading platforms are betting on the speed factor, the idea that Supermicro can get a Blackwell system to a customer months faster than anyone else. That was true in 2024 and 2025, but the reality of 2026 is that the competition has caught up and the speed premium is shrinking. The institutional side of the house, particularly those managed through Fidelity Wealth Management or Schwab Intelligent Portfolios, is likely looking at the debt levels. Supermicro has about $1.4 billion in cash, but its debt is climbing towards $1.9 billion. For a company that was once the darling of the S&P 500, this shift in the balance sheet is concerning. It suggests that the easy growth phase is over and the execution phase has begun. If you are using a SoFi trading platform to manage your individual brokerage account, you have to ask yourself if you are comfortable with a company that is currently under a legal cloud while simultaneously trying to double its revenue in a single year. It is a high-wire act that requires perfect execution at a time when the company is facing internal distractions. Let's talk about what this company actually does for those who are new to the story. Supermicro isn't just a server box company. They have pivoted toward being a total IT solutions provider. Their specialty is liquid cooling, specifically direct liquid cooling, or DLC. As AI chips get more powerful, they get incredibly hot, and traditional air cooling just doesn't cut it anymore. Supermicro spent years building out this liquid cooling infrastructure, while their peers were still focused on fans and heat sinks. This is their moat. The problem is that a moat only works if you can charge a premium for the water. Right now, because they are so focused on winning big contracts with massive cloud providers, they are effectively giving away the cooling expertise just to secure the hardware sale. This is why the gross margin is the only metric that truly matters for the rest of 2026. If you look back at the past few years, the company's trajectory has been nothing short of wild. They went from a relatively obscure server builder to a household name in the investment community, but that fame came with intense scrutiny. The internal controls and governance issues that led to the delay of their financial filings and the subsequent legal headlines have created a permanent risk premium on the stock. Even if they hit their $40 billion revenue goal, the market might not value that revenue at the same multiple it gives to a company like Dell, which has a much cleaner track record. This is where the expectation versus reality framing becomes critical. The expectation is that the legal issues are old news, but the reality is that institutional investors don't like uncertainty, and they will continue to demand a discount until several quarters of clean filings and stable leadership are in the books. Comment below how many shares of SMCI you currently hold, or if you have completely moved your capital into other AI plays like Nvidia stock or even diversified ETFs. The movement we saw on Friday, that 8.7% jump, was likely driven by short covering and a bit of relief after the launch of their Gold Series enterprise server lineup. These are pre-configured systems designed for smaller enterprises rather than the giant cloud players. This is a strategic move to improve margins because smaller customers don't have the same bargaining power as a Microsoft or an Amazon. If Supermicro can successfully shift its mix toward these enterprise customers, they might actually be able to pull their margins back toward that 10% to 11% range. But that is a big if. Marketing to thousands of smaller companies is much more expensive and difficult than selling to 5 or 6 giants. It requires a different sales force, different support infrastructure, and a different marketing budget. Looking at the future outlook for the remainder of 2026, there are 2 distinct paths. In the bull case, Supermicro successfully scales its DCBBS products, the legal clouds dissipate without further major indictments, and the company hits its $40 billion revenue target with a gross margin recovery to 10%. In that scenario, the stock could easily double from these levels because the valuation is so compressed. In the bear case, the margin compression continues as Dell and HPE engage in a price war for the Blackwell cycle, and further legal headaches keep the big institutional players on the sidelines. If margins stay at 6%, the revenue growth won't be enough to sustain the current valuation, and we could see the stock test its 52-week lows again. When you are using investing sites or a Fidelity mobile app to check your portfolio, it's easy to get caught up in the daily green and red candles. But for a stock like Supermicro, you have to look at the structural changes in the industry. The AI server market is maturing. The initial grab everything you can phase of the build-out is transitioning into a phase where efficiency and cost control matter. Supermicro's building block architecture is great for customization, but it is also complex to manage at the scale they are now targeting. We saw this in the last earnings report where about $1.5 billion in revenue had to be pushed into the next quarter because of configuration complexities. This is the reality of building the most advanced computers on Earth. Sometimes they are hard to ship. For those engaging in online investing through platforms like Robinhood or SoFi Invest, the temptation is to treat SMCI like a meme stock because of its high volatility. But this is a $17 billion market cap company with thousands of employees and a massive manufacturing footprint. It's a real industrial giant in the tech space. The core of the investment thesis shouldn't be about a short squeeze or a social media trend. It should be about whether you believe their liquid cooling leadership provides a lasting competitive edge that will eventually translate back to bottom line profits. If the profit doesn't follow the revenue, the stock will continue to struggle, regardless of how many chips Nvidia sells. In summary, Supermicro is a company at a crossroads. The expectations are sky high for revenue, with management doubling down on a $40 billion target that would make them one of the largest hardware companies in the world. However, the reality of their current financial state is one of razor-thin margins and negative cash flow, a combination that has historically been very dangerous for hardware manufacturers. The contrast between their technical leadership in liquid cooling and their recent struggles with internal controls and pricing power have created one of the most polarizing stocks in the market today. Whether you are using interactive brokers for active trading or keeping things simple with Fidelity ETFs and a long-term view, SMCI demands your full attention. The upcoming earnings call will be the moment of truth where we see if the company can finally start turning its massive volume into meaningful value for shareholders. Until then, the stock remains a high-stakes bet on the future of the AI data center.